Welcome to Resilient. My name is Mike Kearney, the Risk and Financial Advisory CMO. Looking back in our Confronting the COVID-19 Crisis series, it was a little over 3 months and 12 episodes ago when we talked about precision in divestiture, execution, and strategy. The topic continues to provide challenges for leaders. As organizations reshape their business, raise capital, and generate value for stakeholders, transactions remain an important and crucial strategy. But how deals are done is vastly different during this pandemic. That's why this series is so important. We explore issues facing leaders today and help them address questions such as, what new complexities have been introduced in the pandemic and economic downturn? How are changes in modeling and valuation taking shape? How does the regulatory landscape and stakeholder expectations influence deals? And how are organizations approaching their deals in today's environment? Increased management and board expectation on improving return on transaction investment, coupled with the roller coaster financial performance over the last 2 quarters, makes confidently executing transactions even more challenging. Today, we'll be talking with 2 partners in Deloitte's M&A transaction services practice, Jeff Bergner and Dave Obers. They will break it down for us and provide insights on the markets and deal complexities. Jeff and Dave, welcome to Resilient. We have started many of our recent conversations with a question which, in my opinion, kind of epitomizes what resilience is, and that's about having hope for the future. So I just want to start off, Jeff, I'm going to start with you. What gives you hope for the future?
What gives me hope is that we're actually seeing some positive economic activity on there, and we'll talk about this a little bit at the back end of this, but I have a role where I deal with IPOs, and throughout this process, I have companies call and want to talk about going public, and when you're talking about April and being locked down and seems like things were going completely the wrong direction, somebody wanting to talk to you about trying to go public and all the positivity around it in 2021 was just something that, you know, I really latched onto, and it's a trend, as we'll continue to discuss, that has just accelerated over the course of the summer. But you could see the people that could see on the other side of the valley of this pandemic on there and see more positive times, and it's just been really refreshing to have conversations with companies like that.
And even back in April, because I would have thought, like you indicated, nobody would be thinking about an IPO at that point in time.
No, I was having like 3 to 5 discussions a week with companies that were seeing the other side of it. Now, as we'll talk throughout the course of this, these are companies that were not as impacted negatively by this. So, I mean, there are winners and losers in this economy on there, and we're seeing that in the M&A market, we're seeing that in the IPO market. But if you have some sort of slant, be it maybe you're in FSI or tech, food delivery type stuff like that, even some healthcare related items, or if you make cleaning wipes or something like that, it could be a home run for you. But if you're, you know, travel related or something like that, it's a very difficult time.
Dave, let's turn to you. What gives you hope for the future?
Yeah, so I guess I'll answer it maybe in 2 ways. You know, on a personal level, you know, my daughter, my family give me a lot of hope for the future and help me keep me grounded in these times. From a professional standpoint, I would say it's really the creativity of professionals to continue to do their job, even in the midst of all these challenges. You know, when the country first kind of shut down in March, you know, we saw almost all the deals being put on hold as people were trying to figure out, you know, how are they going to move forward in this environment. And I think pretty quickly people realized that, you know, it was not going to be a very short-term thing, and they'd have to come up with a way to try and still get deals done. And that's really what we've seen, you know, starting kind of mid-April and onward. We just continue to see more and more deal activity because people are realizing, you know, this isn't going to stop anytime in the near future, and I still have to do my deals. So how can I get it done?
And that's one of the things I think is the narrative about COVID. It's how we've been able to adapt to this new virtual world. You're talking about deals We had previously talked to somebody about closing the books virtually, which I would have thought would have been a real challenge, but it's awesome to see how so many of us have adapted. Jeff, let's start with you on just what are you seeing on your deals, and why is it so different from the past?
So Dave just touched on it. We are seeing a recovery, but I would describe it as a barbell recovery. On one end of it, we have distressed transactions, and some of these, like we saw a number of people that were investing in like restaurant concepts where they believe in the concept, but they obviously the restaurants fallen on hard times. So again, they're looking forward and they want to invest in those. Others we're seeing, pure distress where they're just selling off good assets in order to just try to avoid bankruptcy. And that's obviously a very unfortunate situation. But at the other end, as I was talking about on the IPOs, you have businesses that are winners in this, and they are trying to capitalize on that. And right now is a little bit of an odd time where investors don't really know where to put money. There's no low interest rates. The stock market's a little bit probably more emotional than it typically is. So these winners, either via an IPO or an M&A transaction, they can get very solid multiples right now, and it's an attractive time to sell for them because they have a story that people just want to latch on to positive stories right now, and so they're willing to invest.
Dave, how about you? What have you seen in the last few months?
Yeah, I would echo a lot of what Jeff said. I mean, as I said before, things really kind of came to an abrupt halt in March and slowly trickled back. First, we saw businesses that had been, pretty far along in a process that was put on hold. Those were kind of the first to come back to market. We're seeing a ton of activity in the technology space and healthcare space as for a lot of the business-to-business tech companies, they're actually seeing a big uptick instead of a downturn. Now as we sit here today, some of the other industries are starting to come back, and we're also seeing some opportunistic M&A in distressed companies. And so for areas like consumer, energy, or some of the travel and leisure, there are still deals getting done, but it's more to save a good company that's just fallen on some hard times.
Are there, and maybe this is for both of you, are there any industries that have surprised you that maybe they're more resilient than you would have thought, or where there's more activity than you would have anticipated?
I don't play in FSI, but when I talk to our FSI partners, they have always sounded much more like business like usual, because I think it was easier for that industry to, financial services when I say FSI, but it was much easier for that industry to go virtual. Healthcare was a surprise, and again, that's not necessarily my direct industry, but when they were shutting down all the optional type services, that put a lot of that industry in distress, and there were some transactions that needed to be again, just so that they could keep the doors open on some of those, and that would be an industry that ordinarily would have been extremely profitable and very healthy, no pun intended.
Yeah, I would just say I've actually been surprised by the strength of tech. I think everybody thought maybe it wouldn't be as impacted, but what we're seeing now is almost record level activity in that industry. And so, part of it probably is people just don't know where else to put their capital, and technology seems like a good bet. But I guess I have been surprised by how strong it has been.
How do you actually factor in, though, the uncertainty? Because I think we all would have hoped that we were outside of kind of COVID, but we're still dealing with it on a daily basis, just that grave level of uncertainty. How do you start to factor that uncertainty into this in the future?
Yeah, that's a great question. I think you have to take a deep dive into your financials and really try and isolate areas that you think have not been impacted by coronavirus or kind of as it always has been, and the areas that are changing. Think about whether that change is something that is temporary, or if in a new normal things are not going to look tomorrow like they have historically. And certainly if it was just that easy, everybody could go do that, and everybody could put out decent guidance and have a good idea about where things are going to go. But obviously that's not the case, and nobody really knows what things are going to look like in 4 months, 8 months, 12 months. And so, we're advising our clients to build a lot more dynamic models and different scenario planning into their models, because if the last 4 months has taught us anything, it's that we don't really know what it's going to look like in the next few months.
And Dave, can you talk about the magnitude of some of the losses that we've talked about caused by COVID?
Yeah. I mean, it is really daunting to look at, some companies in the travel and hospitality businesses. We're seeing second quarter revenues that are 20% of what they were a year ago.
Yeah.
So, that's it's so significant. And those are the types of businesses, where they really are in the mode of survival and just understanding how they can get enough cash to pay their bills. I would say for most of the companies that I've worked with over the last several months, it hasn't been that dramatic, but certainly certain client verticals that they may have, or customer verticals, are significantly impacted. So they're seeing revenue drops. There's new costs that they didn't have previously around things like extra cleaning in their facilities, or hazard pay for their employees. But that said, it's not all negative. Businesses are also seeing cost savings from reduced travel and expense. And certain businesses are booming if they're helping businesses function remotely, or helping them with call-in services, those types of things. Those businesses are booming. So there is no one impact that it's having to companies, but it is impacting every company.
Yeah, and your point is right on also. Like, there's costs that have been reduced. I think travel is probably one of the easiest ones to get your mind around. Like you said, or maybe Jeff, that we should, like, we haven't traveled. I don't think I've traveled since early March, other than for personal reasons. So those costs are significantly less as well. What about the impact on GAAP with all of this? Are there any considerations that controllers, accountants should take into consideration?
Yeah, absolutely. One of the biggest things people are questioning right now as it relates to GAAP is, how do I do my impairment analyses? So whether it's goodwill impairment or asset impairments, as we said, it's very hard to predict the future. And, the models that you had for years to estimate future cash flows, well, now there's a lot of question as to whether that's a legitimate model anymore. And so I think that from a GAAP perspective has probably been the biggest impact we've seen, the biggest challenge for companies. And again, I think the advice there is build more scenarios into those models so you can understand, how close you may be to being impaired, and that's when you're really going to get challenged, by your auditors to provide documentation to support the decision to not impair or to impair, depending on where you fall out. And Jeff, I don't know.
Yeah, and Dave, to add on to that, impairment has always been seen by the market as a lagging indicator. It's usually a year or two behind the curve. But if somebody comes out with a much larger impairment in this market than what the investors were expecting, it could be seen as a future indicator, and it could really impact the company negatively. So it's kind of a little bit of an odd dynamic on that vis-a-vis historical times, because otherwise, but the pressure in this would be to blame COVID and just try to write off all your goodwill and intangibles so you don't have to deal with it in the future.
You guys have brought up scenario planning in the models. Is scenario planning experiencing a renaissance now, or has it always been kind of a critical aspect of it, or is it just being ramped up just given the amount of uncertainty?
So a lot of what we do when we do a diligence is we look backwards and you try to, as you talked about guys earlier about normalizing EBITDA, and then trying to mirror that up with the starting point of any financial model. Everything now is much more focused on the future. Like what is going to be the term everybody's using, the new normal. And if you look at a company you're doing diligence on there, that may be corporate wide, or you may have to go market by market on there as people are experiencing shutdowns and being hotspots at different times. It's not like everyone's being impacted equally in all places. So scenario planning and really looking at the data, and I mean, analytics is going to be a huge focus around this on a go forward basis. And that's what we're working with people when we're helping them on selling a company, is being able to, have a wide net on your data as possible so that you could support any type of position. And so, scenario planning, as you said, it's going to be absolutely critical for getting the right price.
Jeff, I want to stay with you. What do you think leaders can do? And I think we've touched on this a bit, but what can they do to evaluate their position and determine how to actually set a realistic valuation?
So again, that goes to what I started with this barbell. So if you're in one of the winning industries right now, it's a great time to sell, because it's been a great M&A market for the last several years. It's probably been the longest continuous trend I've experienced in my 20 plus years in M&A. And right now, those winners are probably even getting a premium to what was already a robust multiple. The distressed type scenarios, it goes to exactly what we were just talking about, the scenario planning, and how long are you going to be in distress, when you're going to come out of it, and when you come out of it, what are you going to look like? Are you going to be at 100% of what you were before, or are you going to be in some sort of 60 to 70% of what your revenues and earnings were on a different scenario? And what your plan is to get back to it, what you think the market's going to be, is going to absolutely drive what your purchase price is. The other aspect of it, and this would normally just be something minor, although it gets fought on every single transaction, but most transactions have a purchase price adjustment mechanism all around working capital, and the standard has always been a 12-month average of going backwards for what it's going to be. Well, nobody wants to average what it was pre-COVID anymore. Yeah. And so some of the transactions we're seeing, and just it's almost like a fist fight around this, trying to negotiate the final working capital. It's not necessarily the most material item for the overall purchase price, but it's become a gating item to actually try to be able to get something to the finish line. What we're starting to see a bunch of people try to do is like split the difference and say, okay, we'll give you so many months pre-COVID, so many months post-COVID, and we don't know what it's going to come out at, but neither one of us is happy. But it seems like a fair answer for both sides. But this has been fascinating. I'm used to working capital fights, but I've never seen them like what we're seeing right now.
And Dave, what are we hearing from the regulators, in particular the SEC?
Yeah, so the SEC put out some guidance, right at the front end of this. As you recall, right, it kind of happened right before most businesses' end of Q1, and they said, there's certain things they're looking for from registrants in their disclosures, and their focus is that companies are putting out transparent information related to items such as an entity's financial position, their liquidity, and capital resources. And so they really want the companies to tell investors, how much cash do I have, how much access to cash do I have, and how close am I to hitting my debt covenants. And that is maybe no different than it always has been, but this is something everybody's very, very focused on. They also put out some guidance, on this concept of EBITDA plus C, through some increased guidance on non-GAAP measures. And as we said, a lot of companies are trying to struggle with how do I frame my historical results given this unprecedented event. Well, they have said that you can make adjustments to your non-GAAP measures for coronavirus items, assuming that they're directly related to COVID-19 or the associated economic downturn. They are incremental to normal operations and non-recurring. And when we say non-recurring, there may be certain things like cleaning costs, for instance, that a lot of companies now have increased cleaning costs, but it's hard to speculate that that's non-recurring because this just may be a new part of life, right? Lastly, any adjustment has to be objectively quantifiable as opposed to an estimate or a projection. And so with that guidance given to registrants, what we've actually seen is that a lot of companies are not making very significant non-GAAP adjustments for coronavirus. And it's really because of that last part that you can't include estimates. And for most companies, other than some discrete costs such as asset impairments, severance if they did some sort of restructuring, the impact is still kind of being estimated. And so I think at the beginning of this, we may have thought there was going to be more non-GAAP measures around coronavirus. It just hasn't really come to fruition yet.
And Jeff, you've talked earlier about the fact that we're starting to see more exit strategies or organizations disposing of certain businesses. What are you seeing? Are you thinking that there's going to be a greater uptick? And what should companies be thinking about when they're contemplating both kind of doing it and potentially executing? If you could maybe just touch on that for a minute.
Yeah, we're seeing a variety of different things that have changed in this. One of the things from an exit is the emergence of these SPACs. There's $4 billion one that was raised over the course of the summer. A SPAC only has like 2 years to get a deal done, and they're on the clock, and so they're very active in the market, and they're one of the buyers. So that is created some market demand. It has helped with some valuations. As I said, we are still seeing IPOs. IPOs are fairly active on there, and it's what people don't know where to really put money. Now, the election, and I don't mean this from a political standpoint, but just it creates a little bit of uncertainty, so that may cause the IPO market to pause a little bit. But it's been robust, and one of the things that's been positive over the last couple of years around IPOs is there was a regulation change that was put out by the SEC, and it allows people to file for an IPO confidentially. And so what you could do is you could file, start the SEC review process, but nobody sees your financial information. So you've maintained that process. But once you file for an IPO, the SEC's got the most regulation. You can relax that and take that IPO document and say, okay, let's start a sale process and put out a confirmation confidential information memorandum on start that process, and you could do what we call a dual path transaction, whereas you tell people, hey, if you want to buy my company, you got to pay me more than what I'm going to get on this IPO. And it puts a lot of stress on a company because you have your day job, you got the IPO you're trying to do, and you're trying to sell a company. So it's basically like 3 full-time jobs at the same time. But if you're a VC-backed company, a PE-owned company on there, that natural tension between the two transactions is an absolutely great way to maximize your proceeds. And it's a trend that we've seen just really continue over the last couple of years. And the pandemic did not slow that trend down at all.
That's very cool. All right, guys, I've got about 4 more questions, and I call this the lightning round. So basically the way that I do this is I will ask a question, both of you get to answer, and the only ask, given the lightning, is that you answer quickly, 2 to 3 sentences. So the first one is, and I'm going to start, Dave, with you. How do you do deals and diligence virtually? And then how do you actually even get confidence in management without being able to meet them face to face? I got to imagine that's a challenge. So Dave, I'm going to start with you.
Yeah, that is a big challenge, and I'll handle maybe the second part of that question first. The reality is there is no there's no way to meet management or get to know them better than doing it face to face. And so, how do you get confidence in management without being able to do that? First, it's about setting expectations with yourself, just knowing that I'm not going to be able to meet them. And I'm just going to have to get over that. But the way we're seeing these deals getting done is just, lots of time spent on video conferencing and being very clear in what you're asking for and really not beating around the bush. I think everybody kind of has less access, so you need to do more with less time.
Jeff, what's your thoughts?
Yeah, I would say that the majority of what we do in diligence was virtual pre this. It's that last piece that you talk about. It's the confidence in the management team, and that's really where our clients are. But it's literally like, how would you to put it in perspective, non-M&A people, how do you hire a whole crew virtually? And do you feel the same degree of confidence today as you did when you could do that one-on-one and take somebody to lunch and spend time with them? You probably don't. I think people have gotten better at it, but I think this will be the first thing that comes back in a non-virtual world is people will figure out how to go meet someplace remotely safely and get to know one another so they could finalize a deal.
Jeff, I'm going to stay with you for this next question. What advice do you have for leaders managing deals in a virtual environment? And maybe just like if there's just one thing, like your number one piece of advice, what would it be?
I don't want this to sound self-serving, but David and I work on this, and we do buy side and we do sell side, and with all the uncertainty on there, having somebody help you on the sell side, legally, tax, accounting, investment banking standpoint to really help position you should be, it's expenses for the company, but it should be money that you get a substantial ROI on there. This is not the time to try to do something, sell your house for sale by owner, not hire the real estate person on there. So that would be the one thing I would tell people to do. Make sure you get professional assistance.
Got it. Dave, what would be your one thing?
Yeah, I would say making sure you have really clean and clear documentation because we don't have the opportunity to go sit with people and work through issues with them face to face. I think that the expectation, if you're not going to be with them, is that you can figure it out on your own. And the only way you're able to do that is by having very, very clean, detailed information.
Cool. All right, Dave, I'm going to stay with you. How is COVID impacting the traditional M&A timeline? Is it shortening it, elongating it, or is it basically the same?
Yeah, I think I've seen it is elongating it a little bit. Again, typically you might have a week of management meetings, 8 hours a day, back to back to back to back. In a video conferencing environment, that's just not an option. And so, there's these meetings are kind of being laid out over a longer period of time. Another issue that I've seen on some of my deals is that, if you're doing a big worldwide deal, there needs to be a lot of regulatory approvals around the world. While a lot of governments are being shut down for periods of time, and people can't get anything done. And so on one of my projects, we almost couldn't close the deal on time because one government was late giving approval because they had to shut down for 3 weeks because of COVID. And so I'd expect it to be a little bit longer, and you may just have to build some time to take into account that not everything's going to go as it usually would.
Is that what you're seeing as well, Jeff?
Yeah, it's what used to get done in 3+ weeks for us is taken 4 to 5. And Dave's right. It's you can't have the back-to-back meetings, and because you don't have to have the back-to-back meetings, there's a lot of times things used to be done parallel on there, and now people have the ability to participate in every single meeting on there, and so the schedules just have stretched it out. Now, there are some transactions that are just pure distress that you're on the clock because they're trying to avoid some bankruptcy or other type situations. But the most of them, it seems like, it's added an extra, at least minimum 2 to 3 weeks to the process.
So our last question, Jeff, I'm going to start with you, and then Dave, you're going to end it for us. And it really kind of goes back to the platform for this podcast, resilience. And so the question that I have for you is, what would you say leaders can do to build better resiliency into their M&A strategies?
Well, I think if you start with resiliency, people are going to be saying, what do I need to do differently so I don't get as impacted by something like this again? And so that's their starting point. And then out of that point, then is it something you build organically, or is there some place you could speed this up? And maybe you go out and you do an acquisition. It might be something globally. It might be something with your supply chain. It may be, a different market. But I think the M&A is going to be one of the key tools in everybody's toolkit to think about how we don't get in the same place that we were in 2020. And so I think this is going to actually cause a uptick in M&A as we come out of this.
Dave, what are your thoughts?
Yeah, I think about that question more of how can we be more successful in doing M&A in this environment and as a result of this environment. And I think it's two things. One, as we talked about, allowing for more different scenario outcomes when you're doing your forecasting and building your plans. I think people are going to be really interested now to understand what the downside risk is, and whereas before you might think of worst case as 3% growth versus best case of 10%. Now maybe worst case is 20% decline, and what does that look like? The other thing I think businesses can do to be more successful and resilient in their M&A is something I talked about before, but being really detailed and clear in the information that you provide to people, because I think both buyers and sellers are going to get down into a lower level of detail using data analytics than maybe they ever have before. And so you need to think about building things from the bottoms up as opposed to the top down.
Awesome. I really appreciate, Jeff and Dave, your time. I always learn something new, and our goal is hopefully we sussed out some things that our listeners hear, but you guys are absolutely on the front line, some great insights. So thank you very much.
No problem. Thank you.
Thank you.
Dave and Jeff, thank you for sharing your 2 cents with our listeners as they navigate the uncertainties of today's world. Doing deals won't stop just because of the pandemic, and it's clear that deals are an important part of many organization strategies to remain competitive and to supplement innovation. I hope the information shared provides some potential signals as well as considerations when addressing the evolving impact of this crisis. We've covered a lot of topics over the last several months. We still have many more to cover. Want to hear something that we haven't covered yet? Hit me up on LinkedIn or Twitter. For more insights across all aspects of COVID-19, just go to Deloitte.com on our COVID page. You can also listen to the Resilient Podcast on Apple Podcasts, SoundCloud, Stitcher, Spotify, or anywhere you listen. Just search the keyword resilient. Until next time, stay safe and remain resilient.